Okay, the title of this paper is Liquidity Risk and Expected Corporate Bond Return. We know what is corporate bond, and then expected corporate bond return. It is the basically by investing corporate bond return and how much money you make per dollar. That's the expected return, your expectation. And the liquidity risk. We will think about liquidity risk shortly, but then this paper is about how or whether liquidity risk affect or determine expected corporate bond return. Okay. So let's take a look at the abstract. I think this is a very topical paper because nowadays, especially in Korea, there is a liquidity shock in corporate bond market. And then it is important to know for not just in corporate bond, it is important to know the relationship between asset price and liquidity risk. Liquidity risk has been, we know liquidity risk is important in stock market, in other market. How about the corporate bond market? Okay, this paper investigate that and then give the nature of the importance of corporate bond market and liquidity. This is important paper. Okay, so this paper studies the pricing of liquidity risk. Pricing of liquidity risk, whether liquidity risk in liquidity affect asset prices, whether it increases or decreases price. In the cross-section of corporate bond, cross-section of corporate bond, what does that mean? Cross-section means that if you invest $1 in various corporate bonds today, then like 1 month later, you will have a different return. For some corporate bond, you make money. For some corporate bond, you may lose money, right? The returns are heterogeneous, cross-sectionally different, okay? Depending on where you invest, okay? So basically, this paper tried to explain the cross-sectional difference of corporate bond return in expectation depending on liquidity risk. So this is very relevant for bond investors because it basically tells you which bond to buy and which bond to sell in consideration of liquidity risk. The authors use data from January 1994 to March 2009. So slightly outdated. So in future, so this period basically does not include the data period for the COVID-19. So future paper could extend this paper, and that would be another interesting research. Anyway, average return on bonds with high sensitivity to aggregate liquidity exceeds that for bond with low sensitivity by about 4% annually. So this is important result. There are 4% gap. Suppose there is a bond with good liquidity and bond with bad liquidity. Bond with bad liquidity generate return 4% higher than bond with good liquidity. Well, why bond with bad liquidity? I'll define what I mean by bad liquidity shortly, but why bond with bad liquidity will generate 4% excess return? Because they should be cheaper. People don't want hold low liquid corporate bond unless they can enjoy premium. I mean lower price. Because price is low, we expect higher return. How much? By 4%. This is important reason. In bond market, 4% is huge, as you know. When I say good liquidity bond, it means the bond with low liquidity sensitivity. When I say good liquidity, it means bond with low sensitivity to aggregate liquidity shock to the economy. When I say bad liquidity, it means the high sensitivity, bond with high sensitivity to the aggregate economy-wide liquidity shock. Then what do we mean by sensitivity? And what do we mean by aggregate liquidity shock? That is very interesting one and important one. Again, we'll discuss that shortly. Anyway, the positive return between expected corporate bond return, the positive relation between expected corporate bond returns and liquidity beta, okay? Liquidity beta, here beta, when in finance we say beta, it is always sensitivity to liquidity shock. So positive relation, expected corporate return and high beta, high sensitivity to aggregate shock, okay? So this positive relation is robust, remains strong when we include default beta, term beta, liquidity level, and other bond characteristics as well. Existing literature always tells that default beta and term betas are important. Those betas are important. Like a capital asset pricing model beta is important to stock price. Okay. In bond market, we know default beta and term betas are important. They are also important. Okay, so we will learn shortly. As well as to different model specification, test methodologies, and variety liquidity measures. The result suggests the liquidity risk is an important determinant of expected corporate bond return. So this paper is important because by reading this paper, you can understand better in corporate bond market. We will learn term premium, term risk, you will learn liquidity, and you will learn default premium. Okay. And you will learn how those affect bond price. But by reading just a paper, one single paper, you will learn a lot. That is very important for corporate bond manager. Okay? So let's look at this paper in detail. Introduction. Financial theory suggests that expected asset returns are related to systematic risk associated with common factors. That's like a finance 101, very important. Okay, what determines asset return in finance? In corporate finance class, or investment class, we learned that asset return is determined by systematic risk, and it is not determined by idiosyncratic risk. Only systematic risk affects asset return. So there is a systematic risk. Systematic risk is basically economy-wide shock. So it is a common factor across all assets. Those systematic factors affect each asset. But then, there is a common factor. There is a common factor in the economy, and each asset produces different return. How they reconcile each other. We have a common factor, and we have a different expected return. We can reconcile both by adding sensitivity. So, okay, there is a few common factors in the economy, that affect all assets. However, each asset has a different exposure. All assets have different exposure to those common factors that generate heterogeneous asset return. This is like a food. In the world, there are numerous food, right? There are infinite number of food. And each food have a different nutrition, okay? The nutritions are, some food are good, nutrition is good, some food are bad. But then there are only 5 basic nutrition nutritional, if I recall correctly, there are just 5 nutritional elements, like protein, fat, and carbon, and those things, right? Those 5. There is only 5 common factors in the food, and each food has a different exposure to those common nutrition factors, which means different amount of the common factors. Finance is exactly the same. We have a few common factors. Each asset, stock, or bond has different exposure, different amount of those common factors. That determines a different, that generates differences in expected return. This is finance 101, maybe one of the most important results in finance. Then the question is, what are the common factors? And what are the exposures to common factors to analyze expected return? In this paper, they particularly focus on one single common factor, one of the factors, which is liquidity factor, and then exposure to the liquidity factor. Each corporate bond has different exposure to the liquidity factor that generates different expected return. Okay. In addition to the liquidity factor, there are of course other factors that are default premium, default factor, and then term factor. We will discuss that shortly. Okay. And then Pastor-Stumble, well, there are big names in about the liquidity. Pastor-Stumble, 2003. Pastor-Stumble published a paper in 2003. That paper investigates whether market-wide liquidity is a state variable important for pricing stock. Okay, so we already have a result for stock market. Pastor-Stumble investigate nationwide liquidity factor. Okay, and they find that those factors, nationwide factor, liquidity factor, affect each stock return. Their study focused on particular dimension of liquidity. Well, there are many ways to determine the liquidity, define the liquidity. They focus on one single dimension associated with temporary price fluctuation induced by order flow. Okay, so in Pastor-Stumble's paper, the definition of liquidity is there is a order flow. Okay, buy order, sell order, flow of buy order, flow of sell order. Then the definition of liquidity in their paper is when there is a flow of the buy order, how much price appreciates. When there is a flow of sell order, how much price drops. If the sensitivity is high, which means when there is a buy order flow and then price increase a lot, then liquidity is low because the stock price is sensitive to the order flow. If there is a lot of liquidity, people trade the stock a lot, then the stock price should not be affected much by order flow. The fact that a particular stock is affected a lot by order flow, it means the stock has low liquidity. Anyway, they find that expected stock returns are positively related to cross-sector sensitivity returns to fluctuate aggregate liquidity. Important result. There is market-wide aggregate liquidity, and some stocks are highly correlated, high sensitivity, highly correlated with their aggregate liquidity, and they tend to generate higher expected return. Some stock has low correlation with aggregate liquidity, and they tend to generate low expected return. Akaria and Peterson develop a liquidity. They now theorize the finding. They develop a liquidity adjusted capital asset pricing model. We know capital asset pricing model, and they adjust existing capital asset pricing model to incorporate this liquidity finding on the time varying liquidity and demonstrate that required return of an asset depends on expected liquidity and covariances of its return and the liquidity with market return and liquidity. Yeah, so we can theorize there is again time varying liquidity, market liquidity, okay, and then required return means it is similar to expected return. Expected return depends on how much is the market liquidity and how much a particular asset is correlate or the covariance between asset return and liquidity. In addition to that, of course, aggregate liquidity and aggregate market return, their correlation and covariance also matter in this paper. Empirical evidence shows that liquidity risk is important beyond the effect of market risk and level of liquidity in the equity market. So basically, it means that we learn capital asset pricing model in corporate finance, but basically capital asset pricing model is wrong because it doesn't take into account liquidity factor. So we have to adjust to capital asset, naive capital asset pricing model. Okay, so now there's another important paper that I want to highlight. Chen, Resmond, and Wee. Okay, Chen, Resmond, Wee. Okay, their paper. Oh, sorry. Chen and Resmond, Wee. examine the cross-sectional relation. Again, it is cross-sectional relation between corporate yield spread. Corporate yield spread. Again, I highlight a lot about what I mean by yield spread. Yield is basically price, right? So yield spread is basically not, it is not return difference. It is price difference. Difference between the levels of price. Anyway, they investigate cross-sectional relation between corporate yield spread and liquidity. Okay, so existing literature has investigated relation between liquidity and bond prices, but not return. Okay, using bond-specific liquidity measure as exploratory variable, they find that liquidity price in corporate bond yield spread. Basically, liquidity determines the levels of corporate bond prices. That the level of liquidity can affect expected bond return or yield spread is not surprising because investors incur transaction costs which lowers bond value by reducing its cash flow. This is natural, okay? Because if a liquidity of corporate bond is again not good, then that bond price should be lower, okay? It means their yield should be higher. Okay? So there is already about the level of price or yield spread. The difference of this paper we discussed today is that this paper focuses on the issue of whether expected corporate return are significantly related to systematic liquidity risk in return, as opposed to the level of liquidity. So they investigated in aggregate systematic risk, not individual bond liquidity, but market-wide liquidity. Plus, they investigate expected corporate bond return, how much you make money by investing particular stock, particular bond over the other. So this paper is more relevant to bond manager. So the liquidity risk in this paper is not the risk that the liquidity really low when investors need to trade, but that the bond value will drop when aggregate liquidity deteriorate. Okay. So in finance, we always highlight beta, which is very covariant with systematic factor. So this paper investigates the systematic risk, covariant with systematic risk. So existing literature, existing papers already investigate whether high liquidity of a bond or low risk of a bond is correlated with higher or low price of the bond. Already using literature investigate. However, this author firstly investigate the correlation between basically they define the aggregate market value liquidity, and then they investigate covariance between the aggregate liquidity and individual corporate bonds, and they investigate whether that covariance affects expected corporate bond return or not. It is their fault. And of course, they find a significant result. More specifically, this risk is determined by how corporate bonds return fluctuate in association with the covariance, in association with the state variable. State variable means macro variable, macro-wide variable, and not by how bond liquidity fluctuates, not just individual bond liquidity, but its correlation with aggregate liquidity. That's the important part of this paper, and that makes this paper distinct and important. Just a moment. Let's go to the first paper page again. Okay. Not good. Please let me know if the font is too small. Okay. And then Pharma French, using Pharma, got the Nobel Prize. Pharma French first showed that default and term premium are important factor for corporate bond pricing. Okay, in corporate bond market, macroeconomic variable, one is default premium. Default premium, we already actually learned that it is credit spread, market-wide credit spread. It is basically return difference between two portfolio. One portfolio is the portfolio with good credit rating, and another type of bond, another portfolio is composed of bond with low credit spread. So we have portfolio with good credit spread bond, good credit rating, and another bond portfolio with bad credit rating. And there is return difference. Portfolio with bad credit rating should have higher expected return. And that difference between the two portfolio is the default premium. How about term premium? Term premium is also the return difference between two portfolio. One bond portfolio with long maturity, and the other bond portfolio with short maturity. And generally, usually, bond portfolio with long maturity should generate higher expected return because they are riskier, right? And the return difference between long, short maturity corporate bond portfolio is called term premium. And Pharma French already find that those two market-wide time series data is important for corporate bond pricing. So covariance of each corporate bond return with those two time series macro variable, default premium, term premium, determine the price of corporate bond or expected return of corporate bond. We already know that, but they didn't take into account the liquidity factor. Gephardt, Hyoung-Goo, and Swaminathan confirmed this finding. These studies have laid a solid foundation for the pricing model of corporate bond. Built on this framework, we explore the effect of liquidity factor. So already we know default premium and term premium matter, and the authors of this paper want to add another premium called liquidity premium. Okay. And De Jong and Dueson 2007 find that corporate bond returns are sensitive to fluctuate in liquidity of the treasury and equity market. So actually there is a hint. That some sort of liquidity affects corporate bond market. Okay, like equity market liquidity and treasury risk-free treasury market liquidity affect corporate bond return. So there is some hint. And Bevo Brandt and Kavajet and Li Wang and He show that persistent liquidity shock have a pervasive effect on government bond price. So there is literature, government bond literature, about the relationship between liquidity and corporate bond return. So basically, the author of this paper complements this study by examining the sensitivity of corporate bond return to fluctuation in the market. I keep repeating this because it is so much important. It is very, very important. Okay, corporate bond return to the fluctuation in the market-wide liquidity and assessing their importance in the pricing of corporate bond. That is the unique of this paper. So empirical evidence from both analogies strongly suggests that. So this is highlight of this paper, summary of this paper. Liquidity factor is important in corporate bond return. Okay, so liquidity effect is important. We find significant monotonic variation, so there's monotonic variation in return of beta sorted portfolio related to liquidity risk, which means that high beta means high sensitivity, low beta means low sensitivity. There is again market-wide liquidity shock. Some bond has high beta or high sensitivity. Some corporate bond has low beta. So we can sort corporate bond in terms of those beta. And then you can wait one more. And 1 month later, there is a monotonic relationship such that high beta corporate bond tends to generate higher return. So you sort the bond in terms of beta, and the next 1 month return, the performance exactly, not exactly, they tend to be aligned with the beta sorting. Beta sorting expect basically 1 month return sorting. That's the finding. And which are independent of respective default and term premium. We know that default, term premium, and credit rating, those are important, but even after taking into account those default term betas and rating, still we find monotonic relationship. Beta sorting predict return sorting. The average return on bond with high sensitivity to the innovation in aggregate liquidity exceeds that for bond with low sensitivity by about 4% annually. So again, the gap is 4%. 4% is huge in bond market. Okay, a significant positive return exists between expected corporate bond return and liquidity beta in the cross-sectional regression. This is natural, right? Because we thought corporate bond in terms of beta, and then test thought should expect the 1 month expected return. So if you regress 1 month corporate return on the beta thought, there should be plus sign, positive relationship. Okay. One standard deviation of past standard liquidity beta above the cross-sectional mean is associated return increase of 97 basis points, like 1%. So if your corporate bond beta is one standard deviation greater than the other benchmark corporate bond beta, then your corporate bond, you expect like 1% higher expected return than the other because yours is more riskier. By the way, one basis point is 100%, which accounts for 20% of standard deviation monthly corporate bond excess return. So corporate bond returns are determined by many factors, but this single liquidity factor explains almost 20% of the variation. That's a lot. More important, we show the strong positive relation between liquidity risk and expected corporate bond return, even after controlling for the effect of other risk factors. Expected liquidity and bond characteristic and other. Here, expected liquidity means it is an individual liquidity of individual bond, not correlation, covariate with macroeconomic shock. Okay. So let's keep is better. Okay, so okay, which data they use? Data, the author's data. Our final sample includes a corporate bond transaction record from January 1994 to March 2009. Slightly outdated. We first remove those data that are apparently recorded with error. It is always time-consuming to clean up the data, but it is important to clean up the data in every data science to prevent confounding effect of embedded options. Some bonds include options. So it means embedded, bond with embedded option. Embedded option means that option contract is included in the bond contract. Therefore, to prevent the confounding effect, they are investigating pure, just a plain vanilla bond. So they exclude the callable bond. Callable bond means bond plus call option. Putable bond plus put option. Convertible bond, and sinking fund bond, as well as a bond with a floater or other frequency coupon payment. They are all important bonds, so you can Google them to find out what kind of bond are they. In addition, we eliminate short bonds, less than 1 year bond, because the liquidity is low for this issue. Okay, which is subject to this bond with high pricing error. So they are too infrequently traded. So data is unreliable. So they eliminate very short maturity bond. Anyway, after this data screening or data cleanup, we also have a total of 11,729 bonds in final sample. In the terms of credit rating, 1,016 AAA bonds, about 2,000 AA bonds, and then 3,398 single A bond, and etc. And they have like almost 3,000 speculative bonds below BAA. Okay. Now return, okay, because their Y variable, their target variable is return, monthly corporate bond return. If you invest in corporate bond and you wait 1 month, you want to know how much you make money per dollar. That's the return. That's the monthly return. So the definition of return is here. That's quite accurate. For the denominator. Denominator is, of course, price you enter plus accrued interest rate, because you pay this accrued interest. And then denominator is basically the difference between this one, denominator, and then new price and new accrued interest, and then coupon you receive in the middle. This is the holding period return, actual amount of money you make per dollar. Okay, so this is Y variable. So basically, the author want to explain how those RT, monthly corporate bond returns, are different between different bonds. What explains the differences? What explains the differences in those returns in each corporate bond? So monthly return of the long-term government bond index and 1 month treasury bill are obtained from the Federal Reserve bond. The default premium is the difference between monthly term or long-term investment grade bond and long-term government bond. Okay, so default premium. This is very important in bond. Okay, default premium is again return difference. Here is monthly return difference. So default premium exists because some bonds are riskier than the other. Risky bond should generate higher expected return, right? Because they should be cheaper. Corporate bonds are exposed to the default risk. And government bonds are not exposed to the default. Here I'm talking about US government bond, and then, well, people generally expect US government don't default. The US government bond don't default, but corporate bonds can default. So corporate bond should be cheaper. Therefore, corporate bond should expect higher return than government bond. Okay. Then how much? How much is the return difference? That's the default premium. Here, the authors match the maturity. They match long-term government bond and they match long-term corporate bond. And there are a lot of corporate bond. Out of a lot of corporate bond, they focus on the investment grade bond above triple B. Okay, of course they can take into account speculative bond, but investment grade bonds are more reliable. So anyway, they also are exposed to default risk, so that's enough for them. So they have a portfolio of investment grade corporate bonds, and they have a portfolio of long-term government bond, and they wait 1 month, and they have a different return, and those return difference is default premium. They calculate that every month and collect that, and they define that as a default premium time series. As you can see, this is a market-wide variable. Okay, default premium is defined. How about now there's a term premium? Another very, very important variable, term premium. Here, term premium in abbreviation, TERM term, is the difference between the monthly return, again, is monthly return difference, with long-term government bond and 1 month treasury bill. Okay, so it is return difference between two government bonds. One is the long-term bond, another short-term bond. There is no difference in both portfolios, but maturity is different. Long-term maturity bond generally generate higher expected return. So what is the difference? If you wait 1 month, how much do you expect is the return difference between long-term bond and short-term bond? That's the term premium. The authors collect this data monthly, and they have macro market-wise term premium time series. And then beside the default and term betas, we estimate beta associated farm-up 23 factors. Those farm-up 23 factors, they are not bond factors. Default factors and term factors are bond factors. And in the stock market, there is just an important factor in stock market, which is like market factor, size factor, and value factor. The stock market and SMB, sorry, here they highlight farm-up 3 factors. Farm-up 3 factors are market factor, size factor, and value factor. Here, size factor means small firm portfolio minus big firm portfolio, and there 1 month return. High minus low is a high value and low value. Here, value is book to market ratio. High book to market ratio firm and low book to market ratio firm. And we know high book to market ratio firm tend to generate high expected return. So they also investigate stock market factors because they want to know whether there is spillover effect. There are stock market factors affect bond prices. In empirical test, we employ 2 market-wide liquidity proxies for corporate bond market: the Pasto-Stumble measure and Army-Hood measure. In this paper, the focus of this paper, in this paper, they are interested in liquidity factor, right? They're interested in liquidity factor. Therefore, they have to define liquidity, right? They have to define liquidity. This one is, they have to define liquidity, and there are 2 ways to define the liquidity. 2 ways to define liquidity. 2 most popular. One is Pasto-Stumble way. Another is Army-Hood way. Industry, in practice, Army-Hood measure is more important, more popular. But in academia, Pasto and Stumble measure is equally popular. There's small difference between industry and academia. Okay, then How to measure liquidity? Okay, first, Pastor-Stambauer liquidity measure. Pastor-Stambauer liquidity measure captures temporary price changes. This is important. Temporary price changes associated with order flow, buy order, sell order flow. It is formulated on the premise that lower liquidity is associated with large price reversal next trading day, resulting from the order flow of a given direction of a particular day. So the intuition is like this. Suppose today we have a sell order flow. If we have a sell order flow, corporate bond price should go down, right? Usually go down. And then tomorrow, well, bond price, we in the class we learned the bond price is the sum of the discounted future cash flow, right? Bond price is the sum of the discounted future cash flow. There is no liquidity there. So if the order flow is temporary, tomorrow the bond flow should go back to the original fair price. Then the price reversal, after order flow, the price go down, sell order flow, price go down, and then tomorrow it is reversed back to the original price, and the reverse amount reversal measures liquidity, illiquidity basically. If stock or bond is highly liquid, it does not affected by order flow money, like Samsung Electronics stock. There is huge trading in Samsung Electronics. So if you buy Samsung Electronics like $1 million or sell Samsung Electronics $1 million, well, it does not affect Samsung Electronics stock price much. However, if you buy or sell like $1 million of a no-name Nasdaq stock, like GameStop, it may like a no-name Kosdaq or Nasdaq stock, that will affect the price. And after order is finished, the price go back to fair price. Okay, because the liquidity is low, so therefore your order flow should affect stock or bond price much. That's the liquidity measure. So the liquidity level for individual bond in period T can be obtained from the least square as well regression equation of here pi it associated with the signed volume in the following regression. Okay, so by running regression for each bond, they can measure the liquidity of the bond. First, VOL, volume is trading volume. There is sign. Okay, so by multiplying sign is like plus or minus. So today's return is positive, it is 1. Today's return is negative, it is minus 1. By multiplying volume and the signed price change, you can guess order sell-driven order flow or buyer-driven order flow. If you look at just data is just volume. There is a volume. Many volume is just matching of buying seller. We don't know whether it's a sell-initiated trading volume or buyer-initiated trading volume. So by multiplying price change plus 1 or minus 1, we can guess whether trading flow is buyer-initiated or seller-initiated. Okay, so by multiplying sign, this part, by multiplying sign, by multiplying sign and volume, here, we can guess, basically we can guess direction of the order, and then this is the price change of the next day, right? So this coefficient, the pi part, this one is basically reversal, the amount of reversal, okay? So when pi is high, if pi is high, it means liquidity is low. Like when pi is low, close to 0, like Samsung Electronics, the liquidity is high. So where RIJT is the return of bond I on JT in month T. REIJT is the bond return in excess of the bond market return. Okay, of course we have to take out in aggregate bond market movement. Okay, excess. When we calculate the sign of the order, we are interested in relative strength. In bond market, in aggregate, go up or go down. But in order to capture the order effect, we want to know when the price moves beyond the aggregate market change or below the aggregate market change. That is sign. If our excess return over market bond return is positive, then the value becomes 1, and the -1 if it is negative. 4 is the dollar volume. The order flow is proxed by, that's what I'm saying. The order flow is proxed by a volume signed by the contemporaneous excess return on a particular bond. In that way, we can proxy order flow, buyer initiated sell order flow, and by matching order flow, by matching the size of the order flow, by matching the size of the flow, and the tomorrow's stock return, basically, we can measure the liquidity. Okay, so any question until now? And then individual liquidity measure are aggregated month by month to generate market-weighted liquidity series. Here, we are not interested in, of course we are interested in, but we want to define market-wide movement, right? We want to define macro market-wide movement. So once we define individual bonds liquidity with pi, then we sum them up like this, month by month. Then we have a market-wide liquidity measure. Individual liquidity measure are aggregated month by month to generate market liquidity measure. We scale the difference in monthly aggregate liquidity measure by the ratio of capitalization of corporate bond in the sample, of course. It's just scaling. Okay, so let's read it. Where NT is the number of corporate bonds in month T to account for effects of a change in the growth in size of the bond market. Okay, so we want to control the sample size. Okay, we are adding individual. So if there are another bond, this one becomes larger regardless of the liquidity. So we need scaling. We scale the difference in monthly aggregate by a ratio of capital entire bond market, i.e. this one. Okay, so this is change, this is important. So pi t here, pi is the aggregate measure. Sum of liquidity of individual. So this one is a change, monthly change in liquidity, and then we normalize it with the, so this is change, and we normalize change with the change of the market size in order to take into account the global change. Okay, market-wide change. Where MT is the total dollar value at the end of T-1 of the bond included in month T. Okay, because we are investing in T period return, so we hold everything at time of T-1, 1 month over. Otherwise, they're looking for the buyers. We don't want to include future information to the current analysis. Okay. So the scaling procedure follows the logic of Pastor and Stumble. So liquidity is now innovation. So this part, some of the, in finance, all is unexpected part. Only unexpected shock affect asset price. So basically, we have a macro-wide liquidity series, but we have to separate out shock to the expected part. So innovation, shock part is called innovation. Liquidity innovation are then obtained from the following different regression, which include lag term and lagged value scaled level. Okay, so basically what they do is that they regress their data to the 1 month ago macro liquidity and then level of the liquidity. So this is regression. So this residual, that regression model cannot explain. This is the innovation. Okay, so residual term for the band liquidity is typically small. We multiply residual by 100. So innovation is basically liquidity innovation determined like this one. multiply 100 to the regression error, because regression error is something model cannot forecast. Therefore, this is innovation part, shock part. And in final, only shock, surprise, affect as a price. Something we already know should not affect as a price. So in this project, we separate the shock from the macroeconomic shock, liquidity shock. Okay. So panel A and figure 1 plus past stumble liquidity innovation. Okay, let's see panel A figure 1. Okay, panel A figure 1. So they plot time series of this liquidity innovations, and then there is a big drop in liquidity innovation at the end of the year 2008 when Lehman Brothers collapsed, my former employer. Okay. So basically they created a time series and it virtually inline, basically inline from our intuition, economic history. Okay. Fleming find a similar pattern using alternative liquidity variables such as price impact, BDS squared. Well, this is like very rigorous, like academic way, academic grade, very academic style way of defining liquidity. In practice, in industry they are sloppy. They are sloppier than academic research. So they have a sloppy definition of liquidity. Instead of this difficult definition, they tend to use easier one, sloppy one, like simple price impact or bid spread, trading volume, and frequency on and off the run yield spread and yield volatility of treasury. And then they find a similar pattern. The pattern is similar to this one. By the way, there is also big drop over here. This is the big drop around 1998, which is in like LTCM. Okay, LTCM. So even if we use a sloppy industry definition of liquidity, still so we have a similar result. Okay, next, let's go back to Hyoung-Goo liquidity measure. Hyoung-Goo liquidity measure is basically also is I mean in academia again, past stumble measure is also popular one in industry. Hyoung-Goo liquidity measure is far more popular because it is easier basically and intuitive. You don't have to use regression. Okay, let's take a look at what is Hyoung-Goo, the famous Hyoung-Goo liquidity measure. By the way, Hyoung-Goo liquidity measure is also important in stock market. When you investigate stock price or stock return, you determine Hyoung-Goo illiquidity measure of the individual stock, Samsung Electronics or Hynix, and they are very important information. Anyway, what is Hyoung-Goo liquidity measure? Okay, very important. The famous Hyoung-Goo liquidity measure focus the price impact of the trade. Okay, basically liquidity is the price impact. Again, as I explained, everyone knows that Samsung Electronics is highly liquid. Government bonds are highly liquid. Even if you buy or sell like $1 million of government bond, it doesn't affect government bond much. But if it is like a small company's corporate bond, selling or buying $1 million will affect the price a lot. So basically, how much order flow affect price or that price impact of the trade is the definition basically behind the intuition of liquidity measure. So Hyoung-Goo illiquidity measure directly focuses on that price impact of the liquidity, price impact of trade. The liquidity for a security is high if a large volume can be traded with real impact on price, and vice versa. Hyoung-Goo 2002 illiquidity measure is defined like this one. Very interesting. So illiquidity measure is the sum, daily sum here. Here it is a denominator is again trading volume. Now nominator is absolute value of the return. So basically price change, amount of price change. So we scale price change with volume. So when this ratio is big, it means that small price volume and large price change. So illiquid. When this ratio is small, it means high volume and then low price change, which means that liquidity is high. So very intuitive. And then we calculate this daily and aggregate. for 1 month. Then you have a monthly illiquidity measure for a particular bond. Where R, let's read, where RIJT is the return for bond I on day J, month T. And days IT is the number of days for each transaction date are available for T. So it is, you basically calculate the ratio between price change and volume, and then you average it over a month. Then you have monthly illiquidity measure of a particular firm like Samsung Electronics, Hynix, or Naver. And then again, we want to define aggregate measure. So we add all the illiquidity measure of individual firm, Hynix, Naver, Samsung, LG, all together, and get the average it. Then we have market-wide illiquidity measure like this. Market-wide measure, average. In calculating monthly illiquidity measure, we windowize illiquidity measure individual at the 1%, 90 percentile. There's always outlier, so we throw away top 1% and bottom 1% illiquidity, and not discard. We basically cut them up and then regard it as top 1% and top 1%, bottom 1%. We modify the value. Similarly, to the Pastor-Stomberg measure, they scale. Okay, similar to the Pastor-Stomberg measure, we scale the monthly difference in the annual illiquidity measure series by the ratio of the capitalized bond, including the sample in each month. Like, so again, the change of illiquidity measure, okay, is the change of illiquidity measure, and then we scale with the bond market size. And then again, we have to extract innovation, surprises. To extract surprises, we regress monthly liquidity change to the previous liquidity change and the level. And then we take into account error term. So this epsilon term, this is the innovation term. Okay, this is something model cannot capture. Other part model can capture. Okay. We also use two dummy variables to capture the shifting also the two implemented phases, trace. I mean, it is because they are data characteristics. Okay, here. So panel A, this one, panel A was Pastor-Stomberg liquidity measure, and panel B is Hyoung-Goo measure. Well, Hyoung-Goo liquidity measure time series innovation. Liquidity innovation looks more noisier, very much, but qualitatively they look, the direction looks similar. Okay. And then let's look at the table. Panel A of table 1 report estimate. Okay, so panel A table 1. So yes, this is the estimation of the Hyoung-Goo liquidity innovation, and then they have estimation. They have an estimate of Hyoung-Goo liquidity measures, and they have estimated variable over here, something like that. And read that variable and do that. So they estimated measure like this one. So by plugging this value each month, and then they can calculate regression error, and the epsilon becomes the show. Okay. We convert the innovation of illiquidity by adding a negative sign. This conversion makes it easier to compare to interpret the result. Okay. By adding negative sign, because they have negative, it becomes now liquidity measure. Okay. We henceforthly also converted the innovation to the minus epsilon head as an Hyoung-Goo liquidity factor, because it is -1 multiplied by liquidity, so it should be liquidity factor. So now it measures market liquidity. Remember in Pastor-Stomberg liquidity measure, here this one, this is the, we have a sign. So basically they tend to move the other way around. So basically, therefore, this one should measure the liquidity because buy order is positive, sell order is negative. So it is usually negative sign. So it is because of negative sign. Therefore, it is liquidity measure here. So the direction is different. So in order to match that, it is like it measures liquidity over here. So we multiply -1 in the amount measure. Okay. So there is estimate. We estimate the sensitivity return. So okay. Now we have aggregate series, right? This is the aggregate one line of one macroeconomic Pastor-Stombo definition of liquidity innovation. And this penalty is macroeconomic variable of amid liquidity innovation. We have two macroeconomic variables. Now next, we estimate sensitivity of returns to market value liquidity for each individual model. Now we have like a 2,000, I forgot, but there are 3,000 corporate bonds, and for each individual monthly return, for each corporate bond, they collect monthly returns, and by regressing each monthly corporate bond return to the macroeconomic time series, then we can get better sensitivity. We can find the sensitivity between macroeconomic liquidity innovation and individual corporate bond return sensitivity. The higher sensitivity, the higher beta. Liquidity beta is then used along with the other risk of variable to explain cross-sectional variation in expected corporate bond returns, like default term and credit rating, those things. Okay. Let's take a 15-minute break.